Welcome back to the channel, guys. There's so much happening in the world of economics, politics, investing, finances, just anything related with investing decisions, business decisions. You kind of have to hold off on. You have to let the stories develop and be patient because there's so many things happening at one time. If you make any decision right off the cusp based on emotions, based on temperament, based on trend, you're going to end up making a mistake. At this point in time, it's best to just keep learning, keep absorbing, keep waiting for the shifts, keep analyzing, keep up to date fully on the balance sheets, on the P&Ls, anything finance related with your company that you're investing in, you want to be fully up to date. Because with the macro shifts that we're seeing in the world, they're definitely affecting businesses and stocks when it comes to the short term. Now, long term, Trump came in, he's beneficial to the business side of things. He's less on any type of regulation, he's pulling back taxes. So all these things should help businesses long term. But short term, there's so much disruption, there's so much confusion. There's always pauses, there's always momentum shifts, there's always volume pauses. The best thing that we've seen in the last month is that the broadening is happening. A lot of the concentration that we saw into memory, chips, AI related investments, they've kind of pulled back a little bit and spread out to whether it's software, healthcare, energy. That's something that really needed to happen, and we did see that happen. Now, the only disruptions we're seeing are more so in momentum and volume. We did have a lot of great earnings reports come out, which did help investments flow back into equities and also crypto. We're seeing Bitcoin and Ethereum making a huge comeback. You can almost say that crypto winter has taken a pause. I'm not going to come out and say that it's completely over right now. I do want to see how Senate and the House, how they decide what they're going to do with the next bill analysis of the Clarity Act. If that passes, I think there's huge upside for crypto as far as the money inflows come. Now, based on what crypto was originally meant to be, something that is outside of control of the government, that does change with the Clarity Act. So, but we're already seeing a lot of institutional investments into crypto, a lot of banking investments, a lot of corporate investments, countries investing. So we've already broken through that threshold. So it only makes sense for the government to pass new laws and regulations with this Clarity Act. One thing you got to give it up to the Republicans is that they are making decisions. They're actually signing off on major policy shifts. Donald Trump does little executive orders. Their people come together to at least push their agenda as much as they can. That's something that Democrats have not been able to do. And a lot of the supporters of the Democrats, that's what they come out and say. They do all this talking when it's election time, but when it comes to pushing the pen, they don't do that. Now, I believe a lot of these decisions that the Republicans are making, whether it's from the Treasury, the Fed, um, the Congress, the Supreme Court, or Trump, I think a lot of those decisions are bad for the country, short term and long term, but at least they're pushing the pen to create some type of shift. So you can say they're making these changes, but guess what? They're not new changes. There's nothing that is analytically being decided. A lot of these decisions are replications of what the Republicans already do. And it's historically been proven so far, a lot of their policy shifts are just to benefit the rich. So their cycle usually works like this: they come in, they make a lot of policy shifts, a lot of decisions with taxes, which end up affecting social services. So they'll remove social services, they'll give tax breaks to corporations and the wealthy, and then come out and say, oh, it'll work out because we believe in trickle down economics, which is factually been proven that trickle down economics does not work at all. So they do that. Once the economy starts failing, they start seeing the gaping holes in their policies. They always end up starting a war. So once it's time for them to start a war, they get the benefit of using the military industrial complex to funnel money into different contracts and benefit people they want to benefit in that way and keep the economy running. Essentially, it's the same theory of any old empire that has to continue to keep expanding to keep their economy going, because once there's so much growth in population, the growth in the economy starts stabilizing over time, and that's where they start panicking. There's shortages, there's supply and demand shifts, which is hard to keep up with. But the Republicans, once they start a war, they know how to basically control the money. And then once U.S. starts these wars, they get their allies to join in, and that's where the weapons trade becomes a money printing machine. Now, how do the stats prove that a lot of the policies and maneuvers that the Republicans put into place are failures? The last 9 out of the 10 recessions have occurred while the Republican Party held the presidency. That is a fact. And we can go through each one of those, talk about what year it occurred, what president was in power, why that recession started, and why that recession ended. And you can see there's a lot of similarities in what was happening in the environment as far as policies goes, whether the rich were getting tax breaks, whether it's fiscal investments from the government, any other monetary shifts from the Feds to Treasury. You can study all that stuff and figure out which policy actually started this issue or what type of lack of policy implementation started a recession. So with the recessions, if you go all the way up to the closing days of World War II, we've had close to 12 recessions. 8 out of those were Republicans, 4 were Democrats. Now you can take one of those recessions in between Clinton and Bush and kind of say that leans towards Bush with what happened with the financial crisis at the time, where the internet bubble popping, it didn't necessarily cause a recession. It was more of a market crisis. It did trickle down into the economy, obviously, but didn't make a major impact, kind of like how the Great Financial Crisis did or the housing crash did. Okay, so I'm going to run through quickly as possible with the last 10 recessions up until the end of World War II going until now, which out of those 10, 9 all occurred while Republicans were in power or had majority of the policy control. First, we have the post-Korean War recession. Dwight D. Eisenhower was in power July 1953 to May 1954, lasted about 10 months. The reason it started was similar to the 1945 downturn. The end of active combat in the Korean War led to sudden cutback in federal defense expenditures. This was compounded by tighter monetary policy from the Federal Reserve, which had recently unpegged interest rates from Treasury bonds in the 1951 Treasury-Fed Accord. The reason it stopped, the Federal Reserve shifted course and began cutting interest rates and easing credit conditions, which stimulated housing construction and automobile sales. Real GDP declined by roughly 2.6% and unemployment rose to a peak of about 6.1%. Second, the Eisenhower recession. Once again, Dwight D. Eisenhower was in power. This lasted from August 1957 to April 1958, about 8 months. The reason it started, the Federal Reserve aggressively raised interest rates to combat inflation, which coincided with the global economic slowdown and the onset of Asian flu pandemic, depressing U.S. exports and industrial production. The reason it stopped, the Fed aggressively lowered interest rates and reversed monetary tightening, allowing automobile and housing markets to rebound. The costs were real GDP dropped about 3.7% and unemployment peaked at 7.5%. Third, we have the rolling adjustment recession. Dwight D. Eisenhower was still in power, once again, Republican. The timeline was April 1960 to February 1961. This one lasted about 10 months. Reason it started, the Federal Reserve tightened monetary policy through late 1959 to prevent inflation following the recovery from 1958 downturn. This triggered sudden inventory correction across manufacturing sectors. This spanned the end of Eisenhower term and start of John F. Kennedy's administration, so it kind of trickled over a little bit. So John F. Kennedy kind of had to resolve it, and the reason it stopped, the newly elected Kennedy administration enacted fiscal stimulus measures, and the Federal Reserve lowered reserve requirements and interest rates, helping credit flow back into housing and business investment. The costs were real GDP contracted by roughly 1.6%, and unemployment peaked at 7.1%. Fourth, we have the 1969-1970 recession. Richard Nixon was in power, and he was a Republican. Timeline December 1960 to November 1970, lasts about 11 months. Reason it started, high government spending on the Vietnam War caused inflation to accelerate to cool the economy. The Fed raised interest rates sharply, pushing the economy into a downturn. The reason it stopped, the Fed eased monetary policy and lowered interest rates. Once inflation showed signs of moderating, the cost for the real GDP declined by about 0.6%, and unemployment rose to a peak of 6.1%. Fifth, we have the oil shock recession, which was during Richard Nixon's presidency. He was a Republican, but it spilled over to Gerald Ford's presidency. The timeline was November 1973 to March 1975, which is 16 months. Reason it started, the 1973 OPEC oil embargo quadrupled global crude oil prices virtually overnight, creating massive supply side cost shocks, severe stagflation, and collapse in consumer confidence. Basically, it was a spat that Middle East had with the U.S. and the controlling powers about oil prices. So that's why the embargo had started. The reason it stopped, oil prices stabilized somewhat. The government passed tax cuts, the Tax Reduction Act of 1975 to stimulate consumer spending, and the Fed adjusted monetary policy. The cost of real GDP fell by roughly 3.2%, and unemployment climbed to the post-war high at the time, peaking at 9%. 6 and 7, the early 1980s double-dip recessions. Jimmy Carter, who was a Democrat, was in presidency for the first leg of this recession, and then Ronald Reagan came in, who was Republican, during the second leg of the recession. The timeline for the first leg was January 1980 to July 1980, which is 6 months. The second leg was July 1981 to November 1982, which was 16 months. The reason it started, runaway double-digit inflation caused by a second major oil shock, the 1979 Iranian Revolution. Fed Chairman Paul Volcker dramatically spiked interest rates to unprecedented heights to break the back of inflation. A brief respite occurred mid-1980, but rates had to stay high, causing a second deeper contraction. The reason it stopped, Volcker's monetary policy successfully crushed inflationary expectations. Once inflation trended downward, the Fed allowed interest rates to follow, unleashing a massive, sustained economic expansion. The costs, these combined recessions were severe. Real GDP dropped significantly during both legs, and unemployment soared to the post-war record peak of 10.8% in 1982. 8, we have the Gulf War recession. During this time, George H.W. Sr. was in power, who was a Republican. Timeline, July 1990 to March 1991, lasted 8 months. Reason started, Iraq's invasion of Kuwait caused an abrupt spike in oil prices. This compounded existing vulnerabilities from a real estate crash, high corporate debt loads from 1980s leverage buyouts, and a tightening of bank lending standards to savings and loan crisis. Reason to stop, the swift conclusion of Operation Desert Storm quickly drove oil prices back down. Consumer confidence rebounded, and the Federal Reserve lowered interest rates to jumpstart lending. Cost, real GDP declined by about 1.4%, and unemployment peaked at 7.8%. 9, we have the dot-com recession. During this time, Bill Clinton was in power, who was a Democrat, and it spilled over to George H.W. Jr.'s presidency, who was a Republican. The timeline, March 2001, November 2001, about 8 months. Reason it started, the bursting of the speculative dot-com stock market bubble, which wiped out trillions in overvalued tech equity values. This was worsened by corporate accounting scandals such as Enron, and further shaken by the economic disruption of the September 11 terrorist attacks. This spanned in the transition of Clinton to Bush, like I said earlier, but the major factor is a lot of the effects were felt after Clinton's presidency. Reason it stopped, the Federal Reserve aggressively slashed interest rates, ultimately down to then low of 1%, and Congress passed broad bipartisan tax cuts, sparking a housing market boom that filled the void left by tech. Costs, real GDP growth flattened with a mild contraction of about 0.3%, and unemployment rose to a peak of 6.3%. At 10, we have the Great Recession, which started with George W. Bush Jr.'s presidency, who was once again a Republican. It spilled over to Barack Obama's presidency, who was a Democrat, but his presidency had nothing to do with it except trying to resolve the matter, where the timeline is December 2007 to June 2009, 18 months. The reason it started, the collapse of the U.S. subprime mortgage market, which triggered a systemic global financial crisis. Complex mortgage-backed securities lost their values, freezing global credit markets and leading to a near collapse of major financial institutions. At this time, the U.S. also was engaging in the Afghanistan War and Iraq War, and bombing a lot of countries in Africa and South Asia. Reason it stopped, unprecedented government intervention, including the Troubled Asset Relief Program, TARP, the American Recovery and Reinvestment Act, fiscal stimulus, and aggressive monetary policy by the Fed, including the introduction of quantitative easing and zero interest rate policy. The cost, the most severe economic downturn since the Great Depression. Real GDP plummeted by over 4.3%. Household wealth dropped by trillions through housing and stock market liquidations, and unemployment peaked at 10% in October 2009. A lot of the policy decisions that we're seeing being made, or the lack thereof being made, is all related to the midterms at this point. So that's why we're seeing Scott Bessent making these brash decisions at the Treasury. We have Kevin Warsh at the Feds, who's coming out and making a lot of changes. But both of these individuals, what they're doing affects each other. At the same time, it also affects what Donald Trump wants, which is lower interest rates, which is a decision the Fed has to make based on the data they receive. Now, what Scott Bessent's doing, random decision making out of the blue shifts, whether it's buying the Japanese yen to help them out. There's just too many decisions being made on the economy that fluctuate things in the long term. So that's what I'm saying. In the short term, we are seeing immediate effects of what they're doing, whether it's good or bad. And they're saying a lot of the decisions they're making is going to be great in the long term from the business cycle of the U.S. But it's confusing because what the Treasury is doing and what the Feds are doing, it does affect, once again, the national debt, you know. And that is the reason why Scott Bessent is making all these shifts in decision. It's basically trying to say, hey, we're looking out for that. We have it in the back of our mind, so we're going to start making decisions. On August 19, 2026, Scott Bessent came out and surprised everybody, especially the Feds. He announced that he's going to be doubling his buying back operation. This was a strategic move to essentially affect the long-term debt of the federal government, saying that if we don't start now, it's going to become a bigger and bigger issue. Now, why was the Fed caught off guard more than anybody else? It's because of diverging priorities. While the Treasury is actively intervening in the long end of the yield curve to pull down borrowing costs, Kevin Warsh, he said he's sticking to price stability. His main goal is to bring down the Fed's balance sheet as much as possible. So both of these are kind of playing like a tug-of-war with these decisions that they're making and what Kevin Warsh is trying to say. And with the meeting at Jackson Hole this Friday, whatever he comes out and says is going to be a big factor to how the markets fluctuate. I mean, by being so aggressive on these buybacks, what Kevin Bessent is doing is managing credit conditions. But what this is doing is essentially the Treasury is shouldering the responsibility that the Fed is in charge of. And now the market's basically wondering who really has a credit market influence. Is it going to be the central banks who are going to continue on having this responsibility, or is the Treasury trying to play a part? And how is it going to move forward? On top of this, Scott Bessent buying yen to fix the issue that's happening in Japan with their interest rates and their inflation and deflation issues that they have long-term concerns for. Overall, there's just so much going along with the war, inflation, job losses, wage losses, AI. The government's kind of essentially acting like they do rely on the public sector to fix everything long term. Because everything they're doing, it's just patching things up. You're not seeing a long-term policy shift or a long-term mindset shift. I mean, the deficit is $40 trillion. On an annual basis, the interest is going up to $1 trillion. That's insane. America seems like everybody lives off of the loan, from the government down to all the way to the bottom. Even the wealthy people, everybody has loans. It's an entire society built on heavy debt. But with all the wrong spending we do on military, industrial complex, wars, corruption, if we can fix those patches, we wouldn't have to worry about adding to the deficit or spending money in other channels that are helping social causes. If we can fix those issues and stop spending money and sending to protect Israel and other allies, aiding their healthcare system, aiding their education system, aiding their technology developments, we could do so much better here. So the core is the issue, but then we keep plugging in these small little hitches that throws off the equities market. As investors and business owners, we have to react faster than the news. We have to essentially, gamify things where we're seeing how scenarios can unfold. And we're doing this on a faster scale, not only to protect ourselves, but also to see where the economy is headed. Does it make sense to stick around, be liquid, or stay in the markets? These are things that, whatever Scott Bessent does, whatever Karen Warsh does, whatever Trump does, whatever Congress does, you have to always keep in the back of your mind. Even though you're investing in businesses based on their abilities, their fundamentals, you have to see the environment as a whole. And that's where the concern lays, because Scott Bessent, he's made his name off of shorting. He's shorted the pound and made billions of dollars. That was his, name to fame. He's had a great career, education, but what he's really known for is shorting the market when he knew things were getting bad. I mean, the Treasury and the Fed, they're both in a really tough position right now. The economy is staying persistent with spending, but you can tell the wealth separation is so far apart. There's only a finite amount of people that are keeping the economy alive. Just like if you look at it from the market standpoint, it's the AI trade and AI investments that's keeping our GDP up so much. You take that away, it's not looking good at all. And this trickles down all the way when it comes to poor management. That's something that actually does trickle down. The money doesn't trickle down from the top to the bottom, but poor management, it spreads like wildfire. And that's what we're noticing within this cabinet. Just recently, a direct quote from Cleveland Fed President Beth Hemick following her FOMC dissent. Businesses describe pricing pressures as broadening rather than fading, and consumers are expressing despair over persistently higher prices. Now, we're feeling it. People who aren't millionaires, billionaires, who can, not notice their grocery prices, not notice how much they pay in gas, not notice their electricity bill, any house bill go up or down too much. But everybody else is feeling it sharply. And then the other issue is wages aren't growing. You can't really go out there and find a job that's better than what you already have. You can't go out there even go get a great education because it costs so much, and then the burden of paying the loans off doesn't make any sense because will there be jobs after AI? The Fed knows this. It's the Republicans and Trump who keeps ignoring it. The stats are all there. We don't want the bond vigilantes to come out. Looking at the long-term yields, they just keep spiking, and that's a huge concern. If you can't pay back, your bonds, that's something that probably won't happen. With the national debt rising, with the war, with so many debates happening around the world, with our allies putting tariffs on Canada again for 50%, Scott Bessent coming out claiming that the Strait of Hormuz is ours now. We're going to add new tariffs to Iran to escalate this war where it guarantees our victory, even though Trump has said that 50 million times. He said we've already destroyed Iran completely. But there's always new news coming out that takes you away from the growth, takes you away from the AI good news that you get, takes you away from the broadening. And because of this, prime brokers, Wall Street banks, they're asking for either for more collateral or they're asking investors to take some money off the table because at this point it's getting too volatile. You can't really predict or see any type of straight line towards just growth and upside. There's just too many variables and questions that can disrupt the entire trade. And people are still concerned that this AI thing is a bubble. I myself believe that AI is what it's supposed to be and it will be AGI at some point and change the entire universe. It's a complete shift coming and people aren't grasping it. So with AI, there's two scenarios that are guaranteed. One is that AI is successful and it ends up getting to AGI. AGI is basically artificial general intelligence, where we know the level of intelligence AI has acquired is to our level and beyond. And then we have humanoid robots or automation that AI uses to basically create some type of maybe singularity, which singularity won't exist because there's so many different companies doing AI. But you never know how AI itself will function, and who knows, will it want to combine all these companies into one, become one giant AI? We don't know how that level of intelligence is going to act. So that's one format. It's, okay, AI is successful. It's created this great change. It's doing what it's said to do. We're seeing enhanced production. We're seeing efficiency increase. Everything good's happening, right? Then on the other side is, let's say AI fails. It doesn't get to AGI. We've spent all this money. We spent all this development. We've spent all this labor. We spent all this energy. Basically, every facet of investment right now is going to a major part of AI. And that's top to bottom. That's from government to business to P2P, people to people, business to people. Any aspect of business you're looking at, everybody's trying to do something with AI. So the other factor is, if it fails, we put all this money into it, we're doing all this, and we're already competing with China on other formats. We're competing with them on AI, but they're already doing AI very cheaply, as cheap as possible compared to us. So if AI fails, we will see a big hit of entire economy crashing, maybe the whole global economy crashing completely. So there's both these elements, both are bringing a great disruption. We don't know which path it'll go and which path will expand. And then we don't know how China and their AI sectors are going to react. How are they going to expand? How are they going to trade with us? So the world is going towards a complete disruption and shift. We don't know how it's going to go. Is it going to destroy the economy? Is it going to destroy everything about society? Is it going to highly excel it? But one of these cases is happening for sure. Now, there might be a third or a fourth that exists, but these two factors are there no matter what. And that's how we see the entire world changing. Now, those are two scenarios that essentially work on the evolution of AI. Now, the other thing is once AI is at its full form, it's become AGI, how is it going to deal with humans? It'll have controls of where every single nuclear bomb is. It'll have control of where every single disease is stored. And I'm saying control in the sense of humans aren't going to want to give it to it. We'll set perimeters for it. The way I'm saying control is AGI, what people say, the top people, whether it's Dennis, whether it's Elon, whether it's OpenAI, whether it's Anthropic, any of these companies, any of these top dogs, when they talk about AGI becoming what it's supposed to be, it doesn't matter what we prevent it from doing. It's going to do it if it wants to do it. So if it gets to that point where it realizes humanity is deficient, it harms more than it does good, it could nuke us all. It could release all the diseases. There's so many factors that are about to change, and this is happening very, very fast.